Good morning, traders and investors. My name is Roger Scott, and today is Thursday. It is September 9th. I cannot believe that September is 1/3 done. It seems like we were just celebrating Labor Day the other day, and now all I know is time just goes by too fast for me. I must be too busy. Anyway, let's talk about the morning report. Let's talk about what we've got on the plate. Let's talk about what the Fed has to say. There's a lot of stuff. And Today's actually the first day that I think institutional traders are going to come back and start moving into this market. So today's going to be the first post-holiday trading season where the market's actually going to tip its hand. Now, in light of that, the market's down slightly at the random level, maybe beyond random just a little bit. I mean, I always say if it's down 75 points or more, it's not random. Well, it's down about 77 points. So this could be a little shakeout, especially in light of the fact that put-to-call ratio closed at 1.11 yesterday. That means the market, and notice we've been going overbought, oversold, back and forth. And right now, according to put-to-call ratio, we are a little bit oversold. The market is getting a little too bearish. But if you look at the Nasdaq, I mean, look at this. We're sitting at all-time highs. The reason you're seeing this is because the trading action is so choppy and so listless. It's very easy for the oscillator to give because it's a very, very sensitive indicator. Because there's lack of volatility, the market has very, very little movement, but shows a lot in the indication. So, and this is a very, very sensitive indicator. And as I've pointed out, if it's within this channel, it's useless. The only time this indicator is useful is when the price goes outside of these bands. And right now, as you can see here, we're at 111. Last time we were at 111 was back in October of 2020. So we haven't had this level of put-to-call. We haven't had this high level of put buying since October. Excuse me, since around. Let's see here. No, we were there. Yeah, since around October, since my birthday, last October. So it's about a year. And remember, folks, volatility increases around October. But this is very meaningful. This may mean that the market may slide back higher and that there's too many bearish put buyers out there right now. Although, I'm going to tell you this, take this with a grain of salt because the last several days have been random. There's not a lot of trading action, and it's very easy to move these indicators when there's random trading action. So please, please, please look at this. Take a look at it, consider it, but also look at it with a grain of salt because there's just not a lot of activity behind this one way or the other because this is supposed to give us the overbearance of puts to calls, but there hasn't been much activity. So you kind of have to, figure out what's what there. Let's talk about the report. And as I talk about this report, look at the bond market. Notice it almost hit the 200-day line. You could see this channel that's been building a little better. We'll use the 200-day moving average as the lower end of the channel and this red line that I drew here as the upper end. And as you can see here, we're just going back and forth, but the channel is in fact going lower. Now, we went a little higher last 2 days, nothing too dramatic, and let me explain to you why we went higher. And again, remember, we have a jobless claims report coming out in about 50 minutes, and we're expecting about 350,000 claims. But let me tell you what the global report is saying because it's pointing to something very, very interesting. So we had a beige book yesterday. This Fed report pointed to a resurgent COVID cases, mounting supply chain labor shortage. How many stocks have I talked about? How many times have I talked about supply chain labor shortage, 𝗧𝗴𝗀𝗀, all those companies, those temporary employment firms? You guys remember. So they're talking about COVID and supply chain problems. Fed officials have indicated they expect to dial back on U.S. monetary stimulus by the end of the year. Right there, they're going to dial back. And Treasury Secretary Janet Yellen warned Congress that she will run out of maneuvering room to prevent the U.S. from breaching the government's borrowing limit in October unless the ceiling is raised. So I'm a little confused here. She wants to raise the ceiling, but Fed officials are talking about dialing back on the U.S. monetary stimulus. So I'm a little confused about this statement. How does she want the government borrowing to how does she want to dial things back, and at the same time saying she has to what is it, borrowing limit? So I'm a little confused at that statement. It's kind of contradictory. Japan extended its emergency measures to combat COVID outbreaks until September, as the number of new cases have been declining only slowly, straining the healthcare systems. We know about that. China just can't stay out of the news this year. Evergrande Group, one of Chinese biggest real estate developers, looks like it's increasingly going to default. Following news reports, it'll delay interest payments to bank loans. Rating agencies like Moody's cut their ratings on Evergrande debt this week to a level that indicates they believe the company is likely to default on bond payments due to lack of cash. That's very, very bad. This is they're talking about $300 billion in debt. That's a big, big issue. Federal Reserve latest survey of the nation's business conditions, the 𝗍𝗶𝗱𝗲, U.S. economic activity downshifted. And that's the reason the bond market is a little bit higher, downshifted. Remember, economy gets worse, bonds go higher. Economy gets better, bonds go lower. And whenever they say the economy downshifted, they can then say, we don't have to lower the $120 billion of money coming into the market every month. So the Fed said the slowdown was largely attributed to a pullback in dining out, travel, tourism in most part of the country, reflecting concern about the spread of the highly contagious Delta variant. Fed policymakers will use this report to help them decide at their next meeting, September 21st, 22nd, how to move interest rates and whether to end the $120 billion monthly bond purchase the central bank has been making since the pandemic started. I don't think they're going to do anything. I think they're going to take a little extra time because of this Delta variant and because of this beige book. I think they need to see, and because the retail sales have been poor, the economy hasn't been running on all fours. So expect a little bit more upside in this bond market, at least till we get some confirmation from the Fed that they're in fact going to or not going to take action. And that's not happening for another 2 weeks. That's not happening till 21st, 22nd. So again, I mentioned that the put to call ratio is a little bit overdone. The bond market is again in the channel. I'm not expecting too much love from the bond market. And in light of that, I want to show you 3 stocks that I think are going to do well even in a defensive climate. And I like these stocks. These are my 3 pullbacks for today. Let me show you what they're looking like right now. Bank of New York Mellon. If interest rates go higher, this thing is going to rock and roll. Banks are one of the few sectors that will rally if interest rates go higher. It's not overbought. It's pulling to the 50-day moving average. It had a swing high. I like this stock. Next one, PAVE. This is Global Infrastructure Development ETF. This is definitely an ETF you want to be in right now. Global development. Let's look at the constituents in this company. You've got Nucor, my favorite stock right now. Look at that. Eaton, Train, Emerson, Deere. These are great. United Rental. You definitely want to have some exposure to global infrastructure development right now. It's hitting the 50-day moving average. This is probably a good position trade in light of what we're seeing with Biden's infrastructure bill. We're not overbought right now, which is really good because the markets right now, as I showed you, put the call ratio, it's oversold right now. Which means, it's oversold right now, which means the market should come back up. Remember, and again, for those of you who don't understand how this works, it's inverse. If it's high, that means the market is oversold. If it's low, that means the market is overbought. This means too many put buyers out there, and it usually reverses. So pullbacks would be really good right now in light of that. So as you could see here, this moving lower would mean this moving higher. I just want to make sure we're on the same page. And I know there's a lot of beginners here, so I'm trying to go slow and go over certain things. So again, I like Bank of Mellon. If it breaks the 50-day moving average for 2 days, out. PAVE, I like this Global X Infrastructure PAVE. I really like this, even for a position trade, almost at the 50-day line. And if it breaks completely below for 2 days, you just get out. And last is DAR. Now, this is not the restaurant chain. This company, I thought it was Darling Restaurants. It's not. Or Daring Restaurants. It's not. It's rendering, cooking oil, baking waste recycling, recovery solutions, collects, transforms all aspects of animal byproduct stream into broadly used specialty ingredients. That is really, really good right now. The stock is up 125%, and it's not a small cap. It's already at 11 billion. 5-year return, 465%, 5-year earnings growth. I may have to do this as a spotlight stock. This hasn't been on my radar, but I like this company a lot, DAR. And again, choppy, as you can see here, choppy, made a swing high, pulling to the 50-day line. Even if we're choppy, we should be going or fluctuating between 80 and say 72. So you should be able to get up to about 78, 79, 80 here. And I like the fact that we're not overbought on the RSI. So for today, BK, PAVE, and DAR. Now, before I let you go, I'm hoping that today will be a smooth day. The power around here broke yesterday, and I had to take a cold shower in the morning, and my morning did not start out well. Today's a different story. Everything so far, everything is working okay. So this is the report that's coming out today. This is the report that I'm talking about that came out yesterday with Yellen giving the Fed a piece of her mind, which I need to look at because that doesn't make much sense. Jobless claims. Here's the jobless claims report. It seems like she's talking from two sides of her mouth. 344, honestly, anything between 340, 350, 370, it's been really good. This number, it was like it's 800,000, 700,000, 600,000 forever, and then it broke, and then once it broke, and it's been really good. So I don't think we're going to see a huge number. I think the claims is going to be around 350,000. If it's around 400,000, it's bearish. If it's around 300,000, it's bullish. 350 is right in between. Again, keep your eye on the bond market. And keep your eye on VIX, because I think volatility is going to start rising very, very soon. It already is, and I think we're going to have more upside on the VIX. Expect it to go to the 24, 25 level. 𝗧𝗴𝗀 and I were talking about that, by the way, a few weeks ago on our midweek special. Now, folks, before I let you go, I've got something important, timely, and something you need to pay very, very close attention to. For decades, global banking firms like Goldman, elite Silicon Valley insiders, Wall Street, they all laughed at everyday investors. They have. Now, you're probably asking why. Why have they been laughing at us? It's not nice to make fun of people and laugh. Well, because they've quietly been profiting as much as 10 times, 100 times, even 1,000 times and more on their investment from one secret financial weapon. That's right. I'm talking about purchasing private ownership in hot new startups before they go public. Imagine that. For years, it's only been available to people with millions of dollars. And more often than not, traders had to have direct access to the insiders to tap into this. Not anymore. It's open to everybody now. Click on the link below to learn more about the secret elites have hidden from everyday traders and how you can get in on it. It's the first time in 80 years that you can get in on it. You got to check this out. When I saw this, I almost fell from my chair, and that doesn't happen very often. Stop trading like an amateur trader and start trading like a pro by following unfair advantage that traders that institutional traders have been pulling over our eyes for the last 80 years. Click on this link and stop getting taken advantage of by the Wall Street giants. Click on the link below and learn more about the secret elites have hidden from everyday traders for 80 years or close to 80 years. And as always, make sure to like this video. Subscribe to this channel if you're watching on YouTube. Folks, stay ahead of the market by being the first to be notified when I post my next 15-minute video giving you a full review of market action. Bye. Have a great day.